Um, so this is Elsayed from the Valuation Master Class. I'm here to provide and to present my initiation of coverage on Nvidia Corporation. I initiate coverage on Nvidia Corporation with a sell recommendation based on a target price of $75.30, implying a downside of 50.8%. I derive my target price from a DCF-based valuation using a WACC of 10.7% and a terminal growth rate of 5%. So let us see why some scars may never heal. My three highlights are short-term headwinds to hit NVIDIA's revenue growth and margins. Gaming would be NVIDIA's future catalyst. And the third one is data center and AI would help NVIDIA's future results to flourish. The three risks that are threatening the company are the supply-demand mismatch, the geopolitical tension between the US and China, and slowing consumer sentiment. So let me first begin with the company background. Nvidia is an American multinational tech company founded in 1993. The company operates in two segments, graphics segment and compute and networking segment, and serves five specialized markets: gaming, data center, professional visualization, automotive, and original equipment manufacturer. Gaming was the highest revenue generator in 2022, while data center was the fastest growing one. The chip maker dominates the discrete GPU market with an 80% market share in quarter two 2022 and is witnessing great expansion in the AI market. So, my first story and the storm that hits the company, which is the short-term headwinds to hit NVIDIA's revenue growth and margins. NVIDIA walked away from the ARM deal, a $40 billion acquisition terminated due to regulatory challenges of ARM, a UK company owned by SoftBank that licenses chip designs that are increasingly vital across the tech industry, losing about $1.35 billion in fees, which showed the first crack in NVIDIA's armor. Also, in the past 2 years, NVIDIA has benefited from cryptocurrencies as miners were using its high-quality GPU cards, charging as much as 40% over its price. But due to the fall in crypto prices, used cards have flooded the market and leaving the company with excess inventories and the disastrous drop in revenue in quarter two 2023 by 19%, which represents the second crack. Recently, the US government added another scar by deciding to ban all semiconductor sales of strategic importance to Chinese companies, which would hurt NVIDIA's revenues as China is one of its major markets. Hence, I expect an overall low single-digit revenue growth of 3% in 2023 and a drop in gross profit margin from 65 to 55%. My second story is gaming would be NVIDIA's future catalyst. So, NVIDIA has always been the best in its class when it comes to gaming, as the company positions itself in a place that allows it to charge hefty prices, knowing that the screening gamers will pay for quality. We cannot deny it. The company recently developed a new gaming chip called the RTX 40 in collaboration with the giant TSMC. The new chip is priced about 25 to 30% higher. So now we are talking about the price, not the volume, as compared to the RTX 30, with a price range from $899 to $1,599. Most importantly, it is not going to be affected by demand fluctuations due to crypto miners, as NVIDIA announced a new chip called CMB made just for crypto mining. So due to this story, I expect gaming to participate in the company's recovery again in 2024 with an overall revenue growth of 31% and a 65% gross profit margin. My last story is about data center and AI. These two segments would help the company future results to flourish. I see that NVIDIA's long-term results would rely more on these two segments. as the company recently added Oracle to its network to bring its products to the Oracle cloud infrastructure, and also extended its partnership with Microsoft to build a massive cloud AI computer. Also, it announced a new GPU named the Hooper with 50% memory than its predecessor. Also, this chip is going to be priced 20 to 33% higher than the 800. Furthermore, Nvidia finally smelled the opportunity and entered the CPU market to compete with AMD and Intel. With its first CPU chip, the Grace, it will be a priced chip mainly for a niche AI market. Hence, I expect Nvidia to achieve an overall high double-digit revenue growth of about 26% on average from 2024 to 2027. As most analysts are always considering the growth opportunities, I want to talk a bit about NVIDIA's constraints to growth. The two major ones are operations and people. People is the major one, as the company has a higher employee turnover ratio of 4.9% as compared to its competitors. Also, decision making is highly centralized in this company, and the tech industry is lacking for skilled laborers. So to find like a skilled employee is going to be like damn hard for the company, given that it has a higher employee turnover. Operations is a major one, as the company has a limited number of customers. It gets significant portion of its revenues from limited number of customers. Also, it depends on a small number of suppliers, which tightens its options to increase production. So because of that, I see that operations and people is going to be a major constraint for NVIDIA's growth. Let me now break down revenues. The chip maker is divided into two operating segments: graphics segment and computer networking segment. The company gets its revenues from multiple geographical regions, but most of the company's revenues are coming from Taiwan, China, and the US, representing 32%, 26%, and 16% respectively of total revenue. Also, the company gaming and data center, where the revenue growth champions in 2022, contributing 46% and 40% respectively, making a huge increase as compared to 2021. The increase reflects higher sales across desktop and notebook gaming GPUs and game consoles. Professional visualization, automotive, and OEM contributed 8%, 2%, and 4%, as we can see, to total revenue, and professional visualization revenues doubled as compared to 2021. According to the FVMR scorecard, which goes in line with my recommendation of selling the stock, Nvidia Corporation appears significantly unattractive relative to 2,060 non-financial companies in the US. According to fundamentals, the company ranked slightly above average, but according to valuation, Nvidia appears highly unattractive, as it is ranked in the 9th decile, as we can see. Momentum is deadly unattractive, as both price and fundamental momentum have not delivered convincing results. And for the risk, the balance sheet risk is high, even with the negative net debt to equity ratio, and the price risk is deadly due to the extremely high beta. Now we're gonna talk like if Michael Porter is analyzing NVIDIA. So the overall score I gave to NVIDIA is 63%, and 100% is best. Rivalry among competitors is 60%, mainly due to the concentrated on high growth industry, as the industry has few players, but all of them large in size and have large market share. Nvidia loses its power against its suppliers and customers, as the company, as I said, relies on third parties to manufacture its products, and also have small number of suppliers, which tightens the company's options. Also, for the customers, the company gets significant portion of its revenues from a limited number of customers. So these customers may decide to not incorporate NVIDIA's products into their products, which gives those customers power over NVIDIA and puts a huge pressure on the company. Now there is no place for new entrants as NVIDIA and its peers have a cost advantage over any entrant that would enter the market. Also, the industry requires high capital expenditure to compete, so which makes it a bit difficult for new entrants to compete with the larger players in the industry. The threat of substitutes, you might find that a bit contradicting here, but NVIDIA and its competitors almost offer the same products, but with some innovation and some differences in the quality. So if the customer doesn't care about the premium quality, his switching costs may be low. But for the gamers and the crypto miners and so on, they're gonna look at the quality. So this smoothens the experience of users. And because of that, NVIDIA is still valued by customers, and this increases the company's brand loyalty. Leadership and ownership. The president, CEO, and founder of the company is Mr. Jensen Huang, and the lead director, which plays the role of the chairman, is Mr. Market Elberry. The top shareholder is the Vanguard Group Incorporated with 7.8% ownership, and the estimated free float is 97.2%. 4% of NVIDIA is held by insiders, and 66% is held by institutions. And if we took like a deep look at the insider trading in NVIDIA, you're gonna find that almost all of the transactions were selling the stock. So this might make you like wonder why they are doing this. So according to the WBC, Nvidia Corporation is a profitable profit champion, as it has always been in the first decile relative to 700 large infotech companies worldwide. Profitability has ranked in the top 10% for the whole period. Most recently, growth fell to number 5 in the past 12 months from number 2 in 2022. Asset efficiency has ranked number 7, but expense control has ranked number 1 for the whole period. And expense control is the main reason behind the world-class performance of the company. Sales growth had ranked number 2 in the past 12 months after a slight drop from number 1 in 2022, but expense direction has been volatile. It was ranked number 10 in 2020, then it dropped to number 5 in 2021, then rebound again to a world-class ranking to number 1 in 2022, then a deadly drop again to number 8 in the past 12 months. I shall skip these. So the ESG scorecard, I give the company a high score, which is the overall 93%, with 100% to social and governance, and the environmental is 80%, as the company has a strong presence in the Green 500 list, as the company powered 23 of the top 30 systems on the June 2022 Green 500 list. And one of the priorities of NVIDIA is to make its GPU cards more efficient, more energy efficient. And also the company plans to build Earth-2, an AI supercomputer for climate change problems. And also the company designed the Inception program, which includes partnerships with 100,000 companies, many of which are demonstrating how daunting climate challenges can be better understood and addressed with artificial intelligence. For the social, the company has environmental, health, and safety policy, has an anti-corruption policy, complies with all applicable laws, and respects internationally recognized human rights. So I gave the company 100%. According to governance, 12 out of 13 directors are independent. And as I said, the chairman and the CEO are different persons. And the company reports ESG and has a CSR sustainability report and so on. So I gave the company 100%. Now for the profit and loss statement, you can see that revenue is going to increase, a slight increase in 2023 due to the headwinds. Then the company is going to rebound again, but this recovery not going to be enough to help the stock rise, in my perspective. Here you can see a huge negative exceptional item number. This is mainly because the termination phase of the ARM deal. The company is gonna gain more cash as it's gonna be a bit profitable, after paying a reasonable amount of dividends and paying back some debts. You can see that inventories almost doubled in 2023. This is because the excess inventory, and this particular issue I'm gonna address in detail in the risk section. Long-term debt, I see like the company is going to depend more on long-term debt in the first 3 years. Then the company is going to make first use of its cash and pay some of its long-term debt, as long-term debt wasn't the company's favorable way of financing as always. For the cash flow statement, you can see capital expenditures hiking than the past. This is to support the company's growth and expansion. As you can see that the artificial intelligence industry, the data centers industry, the electric vehicles and automotive industry and so on, all of it are going to boom, and booming right now. And the company is going to have lines share in these industries. So it's going to need to invest more to support this expansion. Here you can see the inventory conversion period increases in 2023 and 2024. Then it's gonna be a bit less from 2025 and so on. I expect the company to pay reasonable amount of dividends and to return to the level of dividends it was paying from 2013 and to 2017. So for the valuation and target price, I assume a risk-free rate of 3.82%. The US 10-year government bond yield as the day I did my valuation, and a weighted average implied equity risk premium of 6.61% depending on the sources of the company's revenues, and a high beta of 1.13 times. I forecast a capital structure of 7.1% debt to total capital, a bit higher than the current level. This results in a WACC and a discount rate of 10.7%. I use a terminal growth rate of 5% due to the booming of the company's industry, and the company is going to have some opportunities to grow. And I use free cash flows to the firm to value Nvidia. My base case assumes 21.6% sales growth per annum, resulting in a value of $75.3 per share based on the free cash flow to the firm methodology, a 50.8% downside compared to the current market price. In my sensitivity analysis, my base case, as I said, assumes 21.6%, but in my optimistic case, I assume 23.8% sales growth. This would give us 79.1% target price. And in my pessimistic case, I assume 19.4% revenue growth, and this would give us $71.8 per share. So the risks that threatening the company, the main one is the supply-demand mismatch. It has been always the pain in the neck for Nvidia. As Nvidia depends on third parties to manufacture and assemble its products, this requires the company to expect future demand for its products to avoid dropping into a gap between supply and demand. If Nvidia underestimates or overestimates the future demand for its products, the company could suffer the consequences of product shortages and excess inventory. Product shortages may destroy the company's relationship with its customers, which would lead to a loss of revenue and market share because of the increasing lead time. As I said, the company depends on small number of suppliers, so they might not have the capacity to increase production at once. So the company will not be able to fulfill the orders of its customers, so it's gonna lose some of them. On the other hand, excess inventory would force the company to write down this inventory, pay cancellation penalties, and record impairments, like what happened in the second quarter of this year, which would hurt the company's gross profit margin and the overall financial results. The second risk is the geopolitical tension between the US and China, as recently the US government imposed new export restrictions on two of NVIDIA's most advanced AI chips to China. China is the second largest market after Taiwan, making up 26% of the company's revenue. So I see that this would harm the company's short-term results by more than the $400 million in potential sales to China that the company has announced. Also, if the ban continues, this would make the company lose one of the most important markets, as China has already started sharpening its edge in lower-end specialized semiconductors. So it won't take them too long to start thinking about producing the most sophisticated chips that NVIDIA and its US peers provide. The last one is slowing consumer sentiment, as consumer sentiment remained at one of the lowest levels on record, and as a result, retail spending on discretionary goods is seeing a permanent slowdown in recent months. We can see this as global PC shipments have already shown accelerating declines in the first half of this year. So it is expected that the related chip demand could suffer. If this continues, NVIDIA's financial results could suffer again, and we could see more scars in the company's gaming segment results, like what happened in the second quarter of this year. To wrap up, I say that some scars may never heal, so I recommend selling the stock with a target price of $75.30 and a downside of 50.8% as compared to the current market price of $153.17. And now I'm open for questions. Thank you.
Excellent. All right. So my first question is weighted average cost of capital. Some people may look at 10.7 and say, oh, that's too high, and think that, it should be lower. But why do you feel comfortable having it at, almost 11% for the WACC?
Okay. So I depend on the company, the company's exposure to another markets, and also the company's beta is a bit high, So depending on the hiking in interest rates now and the increasing in equity risk premiums, investors are gonna require more to invest in stocks rather than investing in bonds and so on. So I guess that 10.7% is a bit reasonable for the company given the current circumstances in the market.
Okay. And the next question is, the share price has already collapsed quite a bit, and you're saying it's going to go down by 50% from here. What do you think is the key thing that the market still hasn't really processed?
Yes. Okay. So I think the main reason behind the previous high price of the stock was the emotions of the investors, and that some analysts are dressing their reports by multiples and so on. And multiples can be so sensitive to the market and to the market emotions and so on. So when you use multiples and multiple analysts use multiples to value the companies, they're gonna come up with a high target price. So the irrational investors might react. this would help the company to just the stock price to increase a bit. But there's gonna be some time when investors release that this is not the real price of the company, and the real price is gonna be from a DCF valuation. The real price is gonna go down as it did when the company started to show cracks in its results. The share price collapsed from $340 to 100 at some point in time, $112. So I guess it's gonna happen again. It may take some time, but it's gonna happen again.
Okay. And then the other question is, what do you say about investors or others that may say Nvidia is always traded at high multiples? So basically, if you just look at it on face value, look at 2024, it's trading on 46 times PE and about a 14 times price to book. Even if, so let's just say that the market is used to this company trading in an expensive range. And if we look at the overall profitability of the company, it's fantastic. I mean, ROE right now, you can see on average, let's just say 30% ROE. One of the reasons why WACC is high is because it's mainly equity financed. So to be almost completely equity financed and have a 30% return on equity is pretty impressive. So I guess part of what I'm thinking, is there a cushion at some point the market won't push it down anymore because they're okay with the high PE and price to book and they're okay with the ROE? Or what maybe a better question is kind of what would be the catalyst that would get people to realize that I shouldn't be paying so much for this company anymore?
Okay, great. Yeah, it might happen, as you said, that this is the lowest point for the company, and the company is going to rebound again, depending on the company's profitability and so on. And you can see that two of my stories are positive about the company, and then applied this to my valuation. But what the catalyst would be the rationality of the investors when they start to look at the company deeper, and go back to the fundamentals. When we go back to the fundamentals and look at the company from different angles, I always do not believe in multiples, as it can be very sensitive. So when I put money into this company, so depending on these multiples can be tricky. So when investors start to realize that they are not going to pay these such prices for the company, and we can see this in also the FBMR scorecard. You can see that the valuation the company trades at higher multiples as compared to its peers. So this might be one of the reasons.
You mentioned a few different things. One is a crypto collapse. Another one is the geopolitical risk, and then maybe just general slowdown. And you see the share price coming down so much. My question is, that fall from 300 to 100, how would you rank the different impacts? Let's say, was it geopolitical risk that was most significant? Was it crypto falling that was most significant, or some other factor? How would you kind of say, okay, number one, number two that caused that collapse?
Okay, look, the first one is the cryptocurrencies, as the company hided the fact that most of its revenues in the gaming cards are coming from the crypto miners. So it decided to hide that from investors. Then when the crypto prices fall, the company had to just admit it, because the revenues is going to go down. And crypto miners, as I said, were paying premiums above the price to use the GPU cards of Nvidia in the mining. And because of that, the company started to tighten the usage of its new GPU card, the RTX 40, in mining, and introduced another one, the CMB one, for only the crypto mining to avoid the fluctuations and the volatility in the crypto currency market.
Mm.
The second one is maybe like the walk away from the ARM deal rather than the US tensions. The company, this deal is were going to be like great. All investors were expecting like this combination is gonna create synergies and so on. And suddenly the company and SoftBank announced the termination of the deal. So people get shocked, you know.
Mm.
So and the huge number of fees and so on. So this is the second one. And the last one is the US and China tensions. But I guess this one hasn't impacted the stock as much as it can be. You know, if this increased, if you remember what happened with Huawei and the
Mm.
US when it decided to ban and so on, so the company started to make its chips for itself, you know. So the Chinese market might decide to do the same thing. And this would hurt the company the most, as China represents 26% of the company's revenues. So one of the catalysts that would bring the stock down if the US and the political tensions continued, and also the supply demand mismatch. If the company continues to just overestimate or underestimate the demand, it's going to fall in the gap again, and it's going to have to pay fees and so on.
Okay. If I look at the share price in October 2021 and it ramped up, was that the ARM deal that was causing that ramp up? That's October 2021. What was
Yes,
it that pumped up the share price from, let's say, 212 up to 312?
this was the first one, the announcement of the termination of the ARM deal. That's the first one. Then the stock started to increase again. Then the company began to show cracks in the inventory, the excess inventory, and the write down and the impairments on inventory. So the stock started to go down again.
Hmm.
Then,
But I mean, the pump, I'm talking about the rise from October 2021,
yeah,
where
yeah,
it
yeah.
went from 212 to
Here,
2 to 3.
yes,
What was the
here,
market so excited about? I mean, that's like a shot to the moon.
yes. Look, the company was doing great in 2021, you
Hmm.
know, and the quarterly results were like booming. And the company achieved 64% revenue growth in 2021. So it was like massive. And
Right.
in this point in time, the company announced the acquisition of the ARM deal and so on. So this is a huge opportunity to grow.
Hmm.
So this made the stock to go up. And as the stock has a higher beta, it was like going up and down with the market. So it is a bit risky, you know. And I believe in the risks in case of this company rather than the growth opportunities. As the company proved, that's going to be like easily affected with any risk that comes down into the road.
Okay, you can stop sharing your screen. So how does it feel to graduate from the Valuation Master Class?
Oh, like it has been a long journey, you know, but great one. Now I feel like simply I am a 25 years old man with 30 years of experience in valuation. You
Mm.
know, I'm just ahead of my age with about like 5 years in experience. I learned it a lot, you know. I had the experience I was seeking each step and each day since May 2022 till this day, when I started the boot camp till this day, I was learning a new thing. Like from getting feedback on my assumptions and giving the students feedbacks, you will never learn a thing without teaching it to somebody, you know. So when I look at some of the students' reports, look, here it is. He just made this mistake. I'm gonna be careful in my valuation to not just do the same as he did, you know. I guess this journey worth like um, getting early in the morning, spending all the day valuing company and so on. It's really worth it, you know. I
Mm.
just felt alive, and now I'm feeling more alive.
How would you compare how you feel about your understanding of valuation now compared to when you graduated from the Valuation Masterclass boot camp, where you also had a great feeling like you had accomplished a lot, you had learned a lot? How would you compare those two?
Okay, great. When now I can see, I look back then. I may like not say this. I was like, yeah, I just finished the boot camp, you know. But now I can see that like when I finished the boot camp, I was like a good analyst, you know, one that can go and work and so on. But now, not just like one of the top 10%, I feel like I am the whole top 10%, you know. Um, I have the exposure to all sectors. I have experienced all the valuation mistakes. I made them and I corrected them, you know. I looked at this sector, how it works, and the other one, how it works. What is the main thing that affects each sector and each company? I guess the experience, my mind has been like bigger now.
Mm.
I can see the whole picture, you know. Back then, I was just seeing the small part of valuation, you know, just like the little kid valuing the company, starting to valuing companies and so on. Now I am like his father,
Mm.
teaching him how to deal with valuations and tough challenges in it.
And how would you describe if you go, let's just say yourself or any other graduate of the Valuation Masterclass goes to work in a company? What is the value that you think you can bring to a company that you couldn't bring before you started the Valuation Masterclass boot camp and all this whole journey?
Look, the manager in this case, if I haven't started the valuation master class at all, he's gonna have like an ordinary one. He was going to just go and try to do ordinary things and do what all peoples are doing, make the mistakes that all analysts are doing, and so on. So I'm not gonna add any value over the other ones he has. But now he's gonna have like a top one who can bring value and can also uh, correct the other's mistakes.
Hmm.
So it's like the two things. Don't make mistakes and correct the other's mistakes. So this is what all managers are searching for.
Yep.
But the thing is, they cannot find it easily. So, and because of that, I believe that when you finish the valuation master class professionally, you're gonna be one of the top 10% uh, in the field. You know,
Yep.
so it is really correct.
So what would you, well, my last question is, what would be your advice for a young person who's looking at the Valuation Masterclass boot camp and looking at the whole journey? They're kind of overwhelmed. It's a lot of work. It's tough. It, you're exposed, your weaknesses are exposed, and you're gonna have to try to figure out how to improve them. So it's a big mountain to climb for a lot of people. They may say, "Oh, I just want to take an online course that's, a couple of weeks. I can watch the videos and maybe that would get me up that mountain." What would you say to that person?
If he chose to just go with another courses like the ordinary ones, he's gonna like climb one rock, you know, and that's it. The mountain, to climb the mountain, you need the valuation master class. I guess the ordinary course doesn't provide like the real experience they're gonna get in the valuation master class from the very beginning. of the boot camp. This like the ladder that made them climb the 30 years experience mountain in just like a few months from the boot camp and professionally, you know. Each course is gonna just give you this information and go ahead and try to learn, you know. But the valuation master class helps you to transform this information to a real practical experience that would make you like if you are a fresh graduate, you're gonna go to an interview as a fresh graduate with experience. You
Mhm.
know, this experience you're gonna get from the valuation master class. It isn't easy and it will never be easy, but the hard things always pay off. You have to learn, you have to push yourself, you have to just to try to eliminate all your fears and so on. And also they are going to gain confidence. I used to like be a bit nervous before presenting anything and so on before I started the valuation master class, but now I just take it easy, you know.
Yeah.
I'm gonna go and present this and go on, you know.
Now, I think that that
So
was demonstrated in your presentation today.
yeah, thank you.
Mm,
So like it is the easiest way, this tough, but also the easiest way to be an experienced one.
mm,
So you might feel it like a bit contradicting, tough, but easiest, you know. But when you finish it, you're gonna feel it.
yeah.
Now I have the experience to go and just talk with anyone. I can now post on LinkedIn how I want someone to just debate with me about the valuation of this company, you know,
Yep.
and
Yep.
we can argue.
Yep. Well, I just want to say congratulations. And I know you've brought a lot of energy to the boot camp, to your classmates. You've brought that energy into Valuation Masterclass Professional, and you've been bringing that energy into newer students as they're coming in. So for me as a teacher, you are my ideal student in the sense that you grabbed it, you enjoyed it, you brought a lot of positive energy, not only to me and to my team, but also to all the students. And so for that, I would like to tip my
I
hat
love
to
this.
you.
Love this has.
I tip my hat to
So
you.
much. Thank you so much, Andrew.
You
You
made it.
have, yeah, yeah, we have said it before. You told me I'm gonna make it, and I will never let you down,
Yep.
you know. And there is a lot to do, you know.
Mhm, mhm.
Let us figure out how to make all the finance students like valuation experts.
Yep.